Wondering how many people are struggling with their credit scores? A whopping 30% of Americans have a credit score below 600. Good news, though. Yes, you can improve your credit score, and it's not as hard as you might think. Today, we're going to break down the steps to not just fix a bad credit score, but to turn it into a powerhouse of financial opportunity. Whether you're dealing with late payments, high balances, or worse, we've got actionable tips that can make a real difference. Let's kick off this journey to financial freedom and get those credit scores soaring. Understanding your credit score. 1. Concept of a credit score. A credit score is a numerical expression based on a level analysis of a person's credit files, representing the creditworthiness of an individual. Ranging typically between 300 and 850, this score is used by lenders to evaluate the risk of lending money or extending credit. A higher score indicates better credit health, making it easier and cheaper to borrow money due to lower interest rate. 2. Importance in financial health. Your credit score is crucial because it affects your ability to borrow money or access products like credit cards with favorable terms. It can also impact your insurance rates, rental applications, and even job prospects in some cases. Essentially, a good credit score can save you money and open up new financial opportunities. 3. Payment history. This is the most significant factor affecting your credit score. It reflects whether you've paid past credit accounts on time. Missed or late payments can significantly lower your score. 4. Credit utilization. This measures how much of your available credit you're using. Keeping your utilization below 30% of your credit limits is ideal for maintaining a good score. 5. Length of credit history. Older credit accounts can positively impact your score because they demonstrate a longer history of managing credit responsibly. 6. New credit. Opening several new credit accounts in a short period can negatively affect your score. It can indicate a higher risk to lenders. 7. Types of credit used. Having a mix of different types of credit accounts, such as credit cards, mortgages, and car loans, can positively affect your score by showing you can manage various types of credit. Understanding these factors and how they impact your credit score can guide you in taking steps to improve or maintain good credit health. Checking your credit report. 1. Obtaining your free credit report. You're entitled to one free credit report every 12 months from each of the 3 major credit reporting bureaus: Equifax, Experian, and TransUnion. Access these reports by visiting annualcreditreport.com, the only federally authorized website for free credit reports. Alternatively, services like Credit Karma offer free reports and credit monitoring more frequently. 2. Reputable sources. Apart from annualcreditreport.com, ensure any service you use to check your credit report is reputable and secure. Look for services that offer additional features like credit monitoring and alerts without charges. 3. Regular review. Aim to review your credit report at least once a year from each bureau. This regular checkup can help you catch inaccuracies or signs of identity theft early on. Given the digital age's rise in fraudulent activities, staying on top of your credit report is more crucial than ever. 4. Detecting errors and fraud. Carefully examine each credit report section for any discrepancies, such as accounts you didn't open, wrongfully reported late payments, or incorrect credit limits. Identifying and disputing these errors promptly can help safeguard your credit score from undeserved damage. 5. Immediate action. If you spot errors or potential fraud, contact the credit bureau and the creditor reporting the information to dispute the inaccuracy. Quick action can prevent long-term negative impacts on your credit score and financial health. Regularly obtaining and reviewing your credit report from reputable sources is a critical step in managing and protecting your financial well-being. Identifying issues on your credit report. 1. Late payments. Payment history is the most significant factor affecting your credit score, accounting for 35% of it. Even a single late payment can lower your score by up to 100 points depending on your score's starting point. The impact diminishes over time, but late payments can remain on your credit report for up to 7 years. 2. High credit utilization. Utilizing a high percentage of your available credit can signal to lenders that you're over-reliant on credit, potentially leading to a risky financial situation. The credit utilization ratio accounts for 30% of your credit score. Keeping your ratio below 30% is advisable, with lower percentages being even better for your score. 3. Collection. Accounts sent to collections after consistent non-payment severely damage your credit score. Such marks can reduce your score by several points and stay on your report for 7 years. Collection accounts indicate to lenders a history of failing to repay debts, significantly reducing your creditworthiness. 4. Bankruptcies. Filing for bankruptcy has a profound impact, potentially dropping your credit score by 200 points or more. Bankruptcies reflect on your credit report for 7 to 10 years, depending on the type of bankruptcy. This indicates to future lenders that you were unable to manage your debts, making it one of the most severe issues for your credit score. 5. Foreclosures and repossessions. These indicate a failure to fulfill a major loan obligation like a mortgage or auto loan and can decrease your credit score by 100 to 150 points. These marks also remain on your credit report for up to 7 years, affecting your ability to obtain future loans. Addressing these issues promptly and responsibly can help mitigate their impact on your credit score over time. Strategies to repair your credit score. 1. Late payments. Late payments can hurt your credit score a lot because how you pay bills makes up 35% of your score. Fix it by talking to the company you owe money to. Sometimes, if you pay what you owe, they might remove the late payment from your report. Always try to pay bills on time to avoid this problem. 2. High credit utilization. Using too much of your credit can look bad. It's best to use less than 30% of your credit limit. How to fix. Pay down balances and ask for higher credit limits, but don't spend more. This lowers your credit use percentage and can boost your score. 3. Collections. Having debt and collections is serious. What to do? First, make sure the debt is yours. If it is, try to negotiate a deal where you pay some of the debt and they remove it from your report. Always get agreements in writing. 4. Bankruptcies and foreclosures. These can affect your credit for up to 10 years. Recovery plan. Start rebuilding with things like secured credit cards. Pay everything on time and keep your spending in check. It's a slow process, but your score can improve over time. 6. Limit new credit inquiries. Every time you apply for a new credit card or loan, it can lower your credit score a little bit. This is because it looks like you're constantly seeking more credit, which can be a red flag for lenders. What you can do is be very choosy about when and where you apply for new credit. If you really need a new credit card or loan, go ahead and apply. All right, we've covered some super important steps for fixing your credit score. From talking to companies about late payments to keeping an eye on how much credit you're using, these tips can help boost your score. Remember, fixing your credit won't happen overnight, but with some patience and smart moves, you can see big improvements. Now, if you found this info helpful, do me a favor and hit that like button. It supports the channel. Don't forget to subscribe for more tips like these. Sharing this video with your friends can help them too. So spread the word, and I'd love to hear from you. So drop a comment below with your thoughts or any questions you have. Thanks for watching, and let's tackle our credit scores together. Keep an eye out for more helpful videos, and remember, you've got this.